Usually, when you talk about starting a new venture, there's this expectation of a very predictable finish line, you
For
know?
sure, like you get your paper stamped and you're good to go.
Exactly. You file your incorporation papers, the government stamps them, you get your official registration number, and boom,
Okay.
you open your doors, you are officially in business.
Yeah. But step into the world of nonprofits and suddenly that clear finish line is, well, it's just a mirage.
It really is. And that's why we're doing this deep dive today for you. We're looking at an internal briefing file called Demystifying NPO Tax Status to find out why the simple act of registering a charity won't actually save you from the taxman.
Right, and we'll get into why recent and honestly pretty severe rule changes have turned the entire sector completely upside down.
Yeah, it's a lot.
Yeah.
Okay, let's unpack this because right out of the gate, we have to tackle the absolute most costly assumption in the nonprofit space.
The big myth.
The big myth, yeah.
Yeah.
It's this widespread belief that getting an official nonprofit registration number automatically means your organization is tax-free.
Oh, man. Treating those two concepts, like registration and tax exemption, as the exact same thing is a catastrophic mistake. It causes massive, sometimes entirely unfixable headaches for founders down the road. And I think, well, the root of this misconception is just how we view the government.
Like it's just one big machine.
Exactly.
Okay.
People view it as one single monolithic ledger. The assumption is that once you are in the system, every department knows who you are and just treats you as a charity.
Right, which makes sense logically, but it's totally wrong.
Completely wrong.
Yeah.
The reality is that you are dealing with two entirely distinct legal universes, and they are managed by very different authorities with, honestly, opposing mandates.
So if the government isn't a monolith, we need to look at the actual architecture of this oversight. On one side, you have the legal identity, right?
Right, and that's handled by bodies like the Companies and Intellectual Property Commission, the CIPC, or, the Department of Social Development.
And they operate essentially like a registry of births. They just process the paperwork, run a name check, and issue a certificate that says, hey, your organization legally exists in South Africa.
Yeah, but their mandate ends the literal moment that certificate is printed. They do not evaluate your financial model at all.
Not even a little bit.
Not at all. They certainly don't have the legal authority to waive your tax obligations. That power rests exclusively with SARS, the South African Revenue Service.
And SARS has a very different goal, right?
Oh, absolutely. SARS operates with a mandate of revenue collection. To them, every single registered entity is a potential taxpayer until proven otherwise.
Wow. So they don't care about your charity certificate.
They do not care that the CIPC issue you a nonprofit certificate.
Yeah.
They only care about whether your operations meet the strict statutory criteria to actually be shielded from taxation.
Okay, so if you are navigating the system for the first time, think of it like the difference between getting a passport versus getting a free first-class upgrade.
Oh, I like that.
Right, because the CIPC registration, that's your passport. It proves who you are, it lets you in the building, and it lets you travel.
Yeah, but a passport doesn't mean the airline's going to give you free champagne and a lie-flat bed.
Exactly. If you want the financial perk, the first-class upgrade, you have to deal with a completely different department, prove you have the right status, and actually earn that specific privilege.
That is a perfect way to look at it. Registration gets you in the door. It does not grant you the financial shield.
So how do you get the shield?
Well, to get that, you have to actively engage with a specialized division within SARS called the Tax Exemption Unit. And this is not an automated process by any means.
We'll essentially have to beg for it.
Pretty much. You are basically pleading a case for why the state should forfeit revenue we would otherwise collect from your daily operations.
And that brings us to the first layer of actual financial protection an organization can get, which is public benefit organization status, or PBO.
Right, the PBO shield.
Yeah. So when an organization goes through that massive, rigorous application with the tax exemption unit and actually gets a PBO approval, what does it do? The immediate mechanism is internal, right?
Exactly. It deflects income tax from the organization's receipts and accruals. And what's fascinating here is how strictly the tax code views a nonprofit's revenue before and after that PBO status is granted.
Because before you have it, you're just a normal business to them.
Right. Without it, if a charity goes out and raises, say, R1,000,000, SARS views that through a standard corporate lens. They just see taxable income.
Ouch.
Yeah. If standard corporate tax rates apply, a massive chunk of that R1,000,000 just bleeds out to the Treasury before it ever ever reaches the community you're trying to help.
So PBO status stops the bleeding.
Exactly. It's the specific legal mechanism that tells the tax system, hey, this revenue is ring-fenced for public good. It lets the entity actually keep its capital.
Okay, so it shields your receipts, meaning every rand you bring in actually stays deployed on the ground. But, and here's the kicker, shielding the charity's bank account from income tax doesn't convince a corporate sponsor to write a check in the first place.
No, it really doesn't.
That's great for the nonprofit, but what about the people actually opening their wallets? Does PBO status do anything to help the donors?
That is exactly where basic PBO status hits a wall. It does absolutely nothing to directly incentivize the donor.
Wow. Nothing at all.
Zero. It protects the money once it's inside the charity, but it offers zero financial return to the person giving the money. If you want a big corporate sponsor's cash, you have to offer them something valuable on their own tax return.
Which brings us to the VIP room, Section 18A.
Yes, the golden ticket. Section 18A is a completely different level of status that flips the focus entirely. It shifts from keeping the organization safe to empowering the funder.
And how does it do that?
It acts like a state-sponsored matching grant, basically, facilitated through the tax code. When a donor gives money to an approved Section 18A organization, they can actually deduct the value of that donation from their own taxable income.
Up to a certain point, right?
Right, up to a cap of 10% of their taxable income for that specific year.
We really need to pause and unpack the raw financial power of that 10% cap for you. I mean, if a major corporation has 100 million rand in taxable income, Section 18A allows them to redirect up to 10 million rand away from the taxman and into a charity of their choice.
It is massive. It literally turns philanthropy into a strategic corporate tax strategy.
But this introduces the golden rule of the nonprofit tax world. And you have to memorize this. Every single organization that holds Section 18A status is also a PBO, but not every PBO can get Section 18A status.
Yeah, it's a strict one-way street. You have to clear the basic PBO hurdle just to even earn the right to ask for Section 18A.
And here's where it gets really interesting. It's like an exclusive VIP room inside the PBO club. But wait, the rules say only specific activities like welfare, healthcare, and education get this. Isn't it incredibly frustrating for amazing groups focused on sports, religion, or general culture to be locked out of this vital funding tool?
Oh, it is a hugely tough pill to swallow.
Mm.
It creates this incredibly tense, bifurcated funding landscape where those excluded sectors just face an uphill battle attracting large corporate capital.
Because they can't offer the tax write-off.
Exactly. But if you look at the underlying mechanism from the government side, the restriction is highly pragmatic. The list is rigid and exclusive by design.
Why is that? Just to save money?
Basically, yes. The government uses the 18A tax deduction as a lever to direct private capital into sectors that alleviate the most critical, immediate burdens on the state.
Oh, I see. Like things the government would have to pay for otherwise.
Exactly. If private money doesn't fund an orphanage or a rural clinic, the state legally and morally has to step in. So the state is effectively buying relief by offering the tax deduction.
And an amateur sports league, as great as it is, doesn't do that.
Right. It's beneficial to society, for sure, but it doesn't relieve a statutory burden from the government's balance sheet in the same way. The priority list is ruthless.
It is a harsh reality of state economics, but for the organizations lucky enough to operate in those approved categories, holding that 18A status is the ultimate golden ticket, or, well, at least it was.
Right. Until last month.
Yeah, because as of March 2026, and keep in mind, today is April 13th, 2026, so this literally just happened, holding Section 18A status suddenly became a terrifying high-wire act. The whole landscape just experienced a massive shakeup.
It really did. Compliance isn't just ticking a box anymore. It's the whole game now. The authorities brought in this mandatory biannual reporting cycle that fundamentally alters the dynamic between the charity, the donor, and SARS.
Let's break down this new compliance cliff. There's a four-step dance now, right?
Yeah. SARS basically recognized a vulnerability. In the old days, donors would just submit physical or digital receipts to claim their deductions.
Which is pretty easy to fake.
Exactly. It left the system wide open to fraudulent or altered documentation. So to kill that fraud, SARS engineered a closed-loop automated data system. They essentially drafted nonprofits to act as proxy auditors for the state.
Okay, step one used to be simple. Hand the donor a receipt. What is it now?
Now, you still issue a receipt, but it must be perfectly legally compliant with highly specific statutory information. You can't just write, "Thanks for the cash," on a piece of paper.
And step 2 escalates this significantly. You have to collect mandatory donor data, right?
Crucially, yes. You have to extract their official tax reference number at the point of transaction.
So no more anonymous cash.
Nope. You can no longer just pass a collection plate or accept anonymous corporate cash if that donor expects a receipt. You must securely collect and store their sensitive tax data.
Okay, which fuels step 3, the biannual submission. Twice a year, the nonprofit has to compile all this data into a special file, the IT3D, and send it directly to Lars.
Right, and it's not a PDF. It is raw, structured data going straight into the SARS mainframe.
And this sets the trap for step 4. SARS takes that file and they automatically plug it into the donor's tax return. The loop is closed.
Exactly. The donor doesn't upload the receipt anymore. SARS already has it. But here is the terrifying part. The stakes are unbelievably high.
What happens if the charity messes up?
If the NPO messes up their part, the donor automatically loses their tax deduction, period.
Wow. It's like having to do someone else's homework perfectly. If you make one typo on their tax reference number or miss the upload deadline by a day, SARS rejects the file and they literally take away your funder's financial allowance.
That's exactly what happens. SARS will simply not honor the deduction. The risk has been entirely transferred onto the shoulders of the nonprofit's administrative staff.
I mean, imagine the fallout. Your primary corporate sponsor logs into their tax portal and their 5 million Rand write-off has just vanished because your part-time bookkeeper used the wrong software template.
They are not going to blame SARS. They're going to blame you.
Yeah, that sponsor is gone. With stakes this high for 18A and basic PBO status requiring absolute legitimacy, what are the foundational rules every single NPO must follow before they even apply?
Well, whether you're aiming for basic PBO status or the whole 18A package, 2 absolute non-negotiable rules apply to everyone. First, your founding documents, like your Constitution or MOI, must have highly specific SARS-compliant clauses baked right in.
So you can't just download a free template off the internet.
Definitely not. The language has to legally bind the organization's assets. SARS mandates that if the nonprofit dissolves, any leftover money has to go to another approved PBO. It cannot go back to the founders.
Makes sense. Keep the tax-free money in the tax-free ecosystem. Okay, and the second rule is about the people. The organization must be run by at least 3 unrelated people with formal fiduciary responsibility. So what does this all mean? Why the strict no family business rule? Is SARS just trying to kill the mom-and-pop charity?
No, not at all. It's about ensuring genuine public benefit and strict accountability. They are actively trying to prevent a single family from controlling tax-exempt funds as a personal piggy bank.
Oh, right. Because if a husband, wife, and their kid are the only ones on the board, voting on salaries or vendors is just a chat at the dinner table. There's no pushback.
Precisely. By forcing at least 3 unrelated individuals onto the board, you engineer internal friction. Fiduciary duty means these people are personally legally liable if the money is mismanaged.
So they'll actually ask the tough questions.
Yeah, they will scrutinize financial decisions and demand audits because their own necks are on the line. It professionalizes the whole setup.
Well, this really brings us to the ultimate strategic trade-off we have to summarize here. Section 18A is undoubtedly one of the most powerful tools out there to attract funding. But man, it now demands an incredibly high price and administrative compliance.
This raises an important question, though. Is the sheer power to attract those donors genuinely worth the suffocating, ever-increasing administrative headache?
I mean, you really have to wonder, and that brings up a final provocative thought I want to leave you with today. If the new 2026 data compliance rules are so heavy that one simple typo costs the donor their entire deduction, are we heading toward a future where only massive corporate-style nonprofits can actually afford the administrative staff to survive, while vital grassroots community groups just get entirely starved of funding because they can't afford the software?
It's a huge risk. We might be protecting the tax base, but starving the actual community.
It's a heavy thought to chew on. Regulatory systems do not exist in a vacuum. They shape the very things they govern. Thank you for joining us on this deep dive into the hidden machinery of nonprofit tax status. Keep questioning the systems around you, and we will see you next time.